Between scheduling this latest interview for the Investor Insights series and recording the discussion earlier this week, we learnt of the extremely sad news of the passing of Mark Mobius. Mark built a remarkable legacy as one of the pioneers of emerging markets investing, including a hugely successful 3 decades from the late 1980s at Franklin Templeton Investments, where as executive chairman of the asset manager's Emerging Markets Group, he led one of the first major dedicated EM investment teams, which grew to oversee around $40 billion of assets under management. Mark clearly navigated through several market cycles, but while many market participants highlighted the risks of investing in emerging regions around the world, Mark championed and eloquently highlighted the opportunities presented within economies benefiting from favourable demographics, urbanisation and economic catch-up within the region. And so this week we pay tribute and we're delighted to be joined by Carlos Hardenberg, who himself spent over 17 years at Franklin Templeton working closely alongside Mark before their departure together to co-found Mobius Capital Partners, or MCP, in 2018, and also launched the London-listed Mobius Investment Trust. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were joined by Carlos Hardenberg, who co-founded MCP Emerging Markets and has been portfolio manager of the company's single strategy since its inception in 2018. Prior to this, Carlos spent 17 years with Franklin Templeton Investments, starting initially as a research analyst based in Singapore before rising to executive vice president and managing director of the Emerging Markets Group. MCP runs a single equity strategy run in various fund structures, and we discuss some of the differentiating features of this concentrated, high conviction, small and mid-cap focused portfolio in our discussion. The London-listed Mobius Investment Trust, ticker MMIT, looks particularly interesting to us at the moment. The trust is small, at a market cap of just a tick over 100 million, and this perhaps leads to it currently falling off the radar of some investors. However, the shares trade on at over a 15% discount to net asset value currently, representing one of the widest discounts in the EM sector. And despite the fact that shareholders recently approved proposals by the board to change the company's articles to increase the frequency of the company's 100% redemption facility from triennially to biennially, with the next one now due to occur in 2027. This should help support the rating as this approaches, and the identification of unwarranted wide discounts with the potential to narrow over time can very helpfully enhance shareholder returns over a given holding period. The highly differentiated approach is a good fit for the closed-end investment trust structure, in our opinion. And as we touch on in this discussion, this portfolio is laden with stocks playing significant roles in the AI capex build-out, but which sits well below the heavily bid and well-documented mega-cap names playing to this theme. We hope you enjoy the discussion. Carlos, good afternoon. Thank you so much for spending some time for this. How are you doing today?
Gordon, very nice to speak to you today. I'm very well, thank you.
Oh, good to hear. Thank you. So, I mean, to kick this discussion off, I mean, we have to say we were extremely sad to hear the recent passing of Mark Mobius earlier this month. And I mean, from us, our thoughts go out to his family, friends, and of course past colleagues as well, such as yourself. And I wondered, as a kind of small tribute to Mark, whether you could kind of talk us through how you view the kind of legacy that he he left, and the kind of the experiences that he's kind of brought on to use throughout his very long career. Is there anything you'd be willing to kind of talk us through there?
Yeah, of course. And as you know, I've worked with him for the last almost 30 years. So I started working for him back in early 1999. At the time, we just came out of, or the markets just came out of various crises again, the Russian default, plenty of volatility in across actually at that time Malaysia and Latin America. So it was for me the first taste of what was then going to shape the next 30 years of my life, constant volatility. And I think working with him was an extraordinary experience because of his attitude, how he was dealing with volatility and uncertainty. And he would always use very clear principles and apply very clear principles, which really were to be found in the quality of people. So always focusing on businesses which were run by reliable, trustworthy, and also accessible people. And of course, with him, that meant we had to get to know the people. We had to, travel to all these places. And literally, my job began with a 6 months nonstop research trip, never returning home once in those 6 months. And it also meant that throughout the pursuing then many years working with him, it meant, being flexible and bringing the curiosity and willingness to the table to dedicate so much time to travel to these places. And in today's world, looking back, where everybody now talks about work-life balance and so forth, at that time, we didn't know that concept. It was all about work and dedication.
Yeah, no, absolutely. Yeah, thank you for showing that. Yeah, I think I mean, we've been very fortunate to have some fantastic investors come through our office and present. But I think there's a smaller group of fund managers which really grab the attention of both investment staff here and non-investment staff. And I know that I remember the last meeting that Mark came in to present to us. I think perhaps at the start of this trust, actually. And everyone kind of hanging on his every comment. And I think I'm almost certain that many people will have come out of that meeting way more enthused about emerging markets and emerging market investing than they did when they came in. He's definitely in that
Absolutely.
category.
No, and I think you're mentioning a very important point there. He was a fantastic spokesman for the asset class, and he was able to also demystify the circumstances of emerging market investing and bring across this in such a clear, concise, and understandable fashion, which was, I guess, one of the forces that brought this asset class to life.
Yeah, no, absolutely. Yeah, Carlos, thank you for sharing that. Appreciate it. I mean, to set the scene for the rest of the discussion, I wondered if I could ask you to summarize some of those differentiating features to the strategy that you run. I mean, it clearly has a kind of a bias towards medium and smaller size businesses and a kind of specific type of business. But for this audience, could I ask you to kind of run through the typical characteristics that you're looking for when you're kind of thinking about a prospective investment, perhaps?
Yes. And again, of course, I can't do that without mentioning my ex-colleague and mentor and good friend Mark, because we started this together. And the idea was from the very beginning is to say, look, all these emerging market funds, they increasingly look the same, and they increasingly show this tendency of getting closer and closer to the benchmark. So essentially, we're pretending to be active investors, but in reality, we are offering benchmarks. So what is different? Number one, instead of having hundreds of stocks very close to the benchmark, we have a very high conviction, much more concentrated portfolio of at most 30 investment, ideally more towards 20 investments. And in order to manage the risks, we said from the beginning, risk doesn't mean being different to the benchmark. In fact, we have an active share, which measures the overlap with the benchmark of over 98%. So we are completely different. But the way we define risk is investing with, back to Mark's original principle, unreliable people. So we wanted the most reliable people, the most robust management teams, and businesses that are owner operated, not operated and run by proxies, but where the owners have skin in the game. So that's a very large difference to when you look at the benchmark. You have plenty of Chinese state-owned enterprises. You have a lot of giant conglomerates, and it's very difficult to even find out who's really behind those businesses. And in many ways in China, especially, you have the state. So that's very different, but also other risk factors which we take into account. So capital structure. In most cases, businesses in emerging markets go bust or run into trouble is because they've taken on foreign currency loans. They have a poor and unsustainable capital structure. So we wanted that risk out of the way and decided we prefer to invest in companies which in fact have plenty of cash on their balance sheets and can grow their business without having to go out and raise a lot of debt. And then last but not least, maybe that's also important to mention, is the business model itself. We are more interested in technology-oriented businesses, which are innovative, which are able to showcase, in many cases, a robust chest of patents, for example, or any other area which gives these businesses a strong and sustainable moat. And that is really what makes me smile about emerging markets and makes me feel so optimistic about emerging markets, because we, for the first time in a long period of time, we can invest in such businesses in emerging markets. It's no longer just about the next retailer, the next bank, or the next commodity play. It's about innovation. It's about companies that are shaping the future of many industries, and those are the key areas of interest for us.
Yeah, no, that's very clear. Yeah, thank you for laying that out. I mean, was you've made it clear in that answer that you're kind of looking at business fundamentals, and it's very much kind of a bottom-up approach. But I'm going to ask you now a kind of top-down question, I'm afraid, because I mean the impact of the Iran conflict has clearly kind of had a large impact, not least of all the kind of energy supply shock. I just wondered, but before we then go back and talk about the portfolio and some of the fundamental drivers, just whether there were any implications, long term or short term, that you have kind of addressed in kind of changing your outlook or changing your view on any of the investment universe.
We always do, and I think you always have to. You have to be very mindful when you take risks in different geographies, in different currency regimes, in different political environments. You have to be very mindful about these factors. And again, instead of ignoring those factors, and while we are predominantly doing our research bottom up, we are always dealing and spending a lot of time in understanding the neighborhood, the context in which these businesses are operating. I myself, I've lived in Turkey for 11 years, so I've seen the country go from a very reform-oriented period where the World Bank's recipe was basically implemented, to a period where the country then drowned in hyperinflation and unorthodox policies and all the rest of it. So I've learned it myself on a sort of very personal dimension, how important it is to understand the context and the political circumstances, and of course currency. In the more recent history, we have avoided, for example, any exposure to Russia. Even before the conflict broke out, we had no exposure. It was about 6-7% of the benchmark. We've been very cautious about investing in China, which is up to 30% of the benchmark. But when you look at corporate governance, when you look at transparency, when you look at many issues they still have in the real estate space, in many industries where you have huge overcapacity, you have to be careful. And similarly, right now in the Middle East, of course, with the spike in oil prices and supply chain impact, many companies and countries will feel that pain. Although I have to say, and maybe we'll talk about this more in this interview, the current situation in the Strait of Hormuz, to me, is not a long-term structural problem. I firmly believe that it will be resolved relatively quickly.
Yeah, thank you for that. Carlos, I understand you've not long returned from a recent research trip to India. I heard you made a presentation not that long ago, which I listened into. Are you able to share any kind of updated thoughts or things that you companies that you met, or kind of how your outlook in India has kind of changed or evolved since that trip?
Yeah, and traveling to the main areas of interest for us, Taiwan, Korea, and of course India, is part of our regular schedule. So we try to spend quite a bit of time there. And it helps us to gain an insight into domestic developments and insight into, of course, when you meet entrepreneurs on the ground, you sit down with them, you spend hours with them. There's so much you can learn. And no Zoom call in the world can substitute this on-the-ground research. It's still essential, especially in emerging markets. So the recent trip to India has actually reconfirmed my very optimistic, if not to say bullish, view on India mid and long term. You have a combination of very strong political support. The government is sparing no effort to make the environment for entrepreneurs easier, to debottleneck government, to debottleneck bureaucracy in many areas that stood in the way of entrepreneurs in the past. As an example, when I was there just now in March, the government announced a tax holiday for data center investments, um, announced special trading zones for technology-oriented businesses, again, tax incentives for foreign investors. So the government is getting their act together. And at the same time, in parallel, you have a lot of private sector enterprises that are investing heavily in India in many areas. So for the first time, India is now playing a significant role also in tech exports, and they're developing more and more expertise in this field. So they see themselves in the future in competing more and more with Southeast Asia, with the models that you otherwise find only in Korea and Taiwan. But then, they're also blessed with 1.4 billion people, a very young, very dynamic, very hungry population that want to move forward, that want to become more affluent. So with this, you have plenty of opportunities. For example, we have invested in a company called Grow, which is a leading online brokerage, which is now trying to compete as a very cost competitive wealth manager, but sort of a new wealth manager for the more affluent younger generation that doesn't need heavy boardrooms, but they want a good functioning app. Or alternatively, we've also invested in a new business which is offering surveillance camera systems for real estate projects or infrastructure, shops, malls, etc. And the Indians have now come up with a new law prohibiting imports from China because they don't want the dependency and vulnerability that comes along with working with Chinese infrastructure. So they want domestic champions.
Yeah, great. Thank you for those examples. Yeah, appreciate that. I mean, one of the features of the last several years has been you mentioned already in previous answers the kind of caution on the Chinese market and the kind of mid to long term bullishness on the Indian market. But one of the features of the last several years has been those kind of notable swings in the market leadership within emerging markets. Certainly not kind of one group. It's kind of very disparate when you look within emerging markets. Could I ask kind of how the portfolio is kind of navigated through that period? Have you made changes kind of through time to try and kind of benefit from that?
Yes, of course. You don't stand still. On the one hand, you try to keep turnover low. On the other hand, you try to, you learn every day. It's a constant learning, and the environment is not standing still, especially at the moment where you have such dramatic innovation also coming from AI. We have definitely uh, undergone one significant transformation over the last 8 years. We've moved away from the more traditional, for example, software plays in emerging markets. They also get disrupted from AI to more AI-based investment ideas. So we've invested in a company which is, for example, starting maybe from the more simple beginning of the value chain within AI. We've invested in companies which are developing components and infrastructure for electrification. So cables and wires for data centers, transformers for electricity distribution and generation. This is an essential part of the portfolio, all the way to data centers themselves. So we invested in component developers of the actual data centers. They have to be of the highest quality you can imagine. It's a very patent-based development of these components. And again, these are businesses which are highly profitable and run by really innovative, smart people. They're predominantly in Taiwan and Korea, as you can imagine. We've also invested in companies like a Chroma in Taiwan, which has developed some of the best semiconductor testing equipment. This is for system level tests where the also AI infrastructure, chip infrastructure is being tested. So across this whole value chain, we see a multi-year runway of sustainable earnings growth for businesses within this area. But we've also then invested, for example, in companies which are, and now we're going down into much more specialized components, businesses which have developed a copper-clad laminate, which is a special coating for printed circuit boards. So it gets a little bit more technical here, but what you should know is that, I think what used to be dominated by the US and even in the earlier days, European companies, is now increasingly moved to emerging markets where they are leading in developing components for some of the most sophisticated industries we have right now on the planet.
Yeah. It certainly strikes me when listening to you in various presentations that you made that the AIs are and kind of the technology themes are a big one for the portfolio. It's clearly been a hugely significant theme for across all markets. But this portfolio, because of where its focus is kind of sitting slightly beneath those really high profile names, those kind of mega cap names within this theme. I mean, could I ask you to maybe just expand on kind of the valuations that you're seeing there, the differences in kind of how you see your portfolio in playing the AI theme, and kind of given how significant that theme has been for investors, what sort of valuations are you finding there when there has been scrutiny on the valuations of some of the larger names in this space?
Well, it really depends. When you, for example, look at some of the very large players in Korea, which are now benefiting from AI infrastructure, i.e., memory DRAM producers like Samsung Electronics or SK Hynix, because of this extraordinary spike in DRAM prices, an extraordinary increase in earnings, the valuations, even among some of the large caps, are still very reasonable, if not cheap, compared to what you would have to pay for similar opportunities in the US or European markets. So the picture is quite, I would say, mixed, depending on what type of business you look at. So within memory, as I said, still reasonable valuations. Within the testing businesses, everything around microprocessor testing. Again, I think because they are earning so much more and earnings per share has grown so significantly, the valuations are still quite reasonable. But then, of course, that's clear that in India, in my career so far, I've never come across any opportunity that would fit into the framework of a traditional, you know, pure play value investor. You just don't get that opportunity in India. You always have to pay a relative premium compared to even some other emerging markets in Asia. But then also the growth is higher. So it was definitely not a good idea to stay away from names in India just because they're slightly, trading at a slight premium. That premium is typically quite sticky. The good news is that right now, compared to the last, I would say 3-5 years, because India hasn't performed well in the last 12 months compared to some other markets, India actually looks reasonably cheap compared to its own history.
Yeah. Yeah, thank you for that. Carlos, I wondered if I could quickly kind of return to another point you made, I think right at the start, talking about the kind of management of risk. And it's clear focus on those founder owners is kind of a key part of that. But I guess another part is the engagement angle, which I know has been important for the strategy over its life. Could I ask kind of how you kind of think about risk in the portfolio, but also kind of how you look to engage and kind of improve shareholder returns and that sort of thing?
Yeah, so this has been a project that we pursued with great passion from the very beginning, which really means that for every investment we make, for every company we're interested in, we think that because of our experience in the past and because of our ability to also look beyond borders and beyond sectors and industries, we have a good understanding of what's required for a business to be best in class, not just in their operations, but also in terms of governance and disclosure-related aspects and transparency. So we think that we can provide this know-how and knowledge and this perspective to management teams and controlling families, and are just very keen to work with management teams and families in their journey to also become best in class in those areas. If a management team or a controlling family shows absolutely no interest and goes even further in sort of disrespecting the positions of minority shareholders, that to us is a risk which you will not get compensated for, especially when things get rough. It will hit you very hard. So therefore, these are principles which we think are absolutely essential. So I think it's a combination of factors. You have to find the right business, you have to find the right company, you have to find the right management team, but then also you have to find a willingness to understand that minority shareholders need to be fully respected and that transparency, etc., is very important. Give you an example. We invested in Korea in one of our top holdings, Classes, which is a champion in exporting medical aesthetic devices. They are very successful as a Korean family-owned business in Brazil, in Latin, in Peru. They're very successful in Japan. They're very successful in places very far away from Korea. And when we started to look at this business a number of years ago, we noticed they had not translated their annual report into English. They wouldn't conduct earnings calls in English. And actually, the content itself of their investor presentation material was also not really best in class. So we said, look, the business is fantastic, but they have governance issues or they have transparency and reporting issues, and pitched the idea to the family and the management to improve things. And they immediately were extremely amenable, extremely positive to these ideas, and even implemented them faster than we hoped for, which translated then into a broader shareholder base, a more diversified shareholder base, more, the investment case came to the attention of more and more investors. So this is, of course, an ideal case.
Yeah, no, great example there. Yeah, thank you. Carlos, one final question at the end. It's a question we've asked most of the speakers on the series. It just asks them to kind of highlight one area of the universe, of their investment universe, that they have a kind of particularly high conviction in at the moment, or particularly positive on. I mean, you've mentioned certain specific areas as we've gone through, but is there one area that you haven't highlighted, or that you'd highlight as being particularly positive on at the moment?
Well, I have to repeat to some degree what I said earlier. I think we tend to underestimate the transformational nature of AI in all different industries around the world. And we're just we're just at the beginning of that journey. And the associated investment opportunities, companies which are now, which are fast enough, which are adjusting rapidly, which are investing in the right fields, they can, they to me represent some of the best investment opportunities. You just have to find them. And therefore, our focus on Taiwan, our focus on Korea, our focus on Southeast Asia in general, that's really where the music is playing right now in this regard. But I have to also mention that I also would not ignore the power of a more affluent emerging market consumer. That's the next really exciting area of our focus right now.
Yeah, no, thank you for that. Carlos, as always, really fascinating to hear your current thoughts. I really appreciate you joining us today. Thank you.
Thank you very much, Gordon. Great to speak to you.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.